Hello, what's up, guys? I'm Haya Fayaz in ACCA affiliate, and as you might have already observed from my previous YouTube videos, it's just going to be about answer techniques of answering questions, helping you cracking jobs, what career options you should pursue after ACCA, and of course the teaching, simplifying various difficult topics, the ones which were conventionally known as tough, conventionally known as difficult, trying to decompose it, trying to simplify it for you, and then present it to you. So today, one such topic that we are going to cover is about foreign exchange derivatives, how to identify what is being asked in the question, how to identify the uh, you know how to figure out what is beneficial in the question, how to comment. Especially, this is for the advanced financial management paper. Let's get started. Let's not waste any further time. And it's actually a technical article which I will walk you through, which is like already presented by the tutor, already presented by the ACC examining team as to how exactly we have to answer the question. We have to identify, uh, the way of answering the question, the benefits, the losses, how to identify all of that, and the lock-in rates, and all of that. So usually, what we end up doing, the mistake that we end up doing, is we don't consider the 25 marks, the easy 25 marks coming from such topics. We lose them because of the time that we consume in the first question, which is of 50 marks. Of course, that is of high importance because of the weightage given for that in the paper, but that doesn't mean we lose on the easy marks. We have to work smart. So, today, let's figure out how to simplify it for you. So, here I'll just walk you through that article and let's get started. Hoping that it helps simplifying the topic for you. And there we go. So, let's just share the screen. Share the screen. Okay. Yeah. Here's the screen. Here's the thing that I was talking about. Um, yeah. So this paper has this question, this type of question. It's frequently examined. It is something that you should know about. Let me. Can I mark something in using this? No, I can't. Okay. Wish I could. Okay, fine. Yeah. So this is like something that has been adapted from December 2018 exam. And see, any past paper is okay. Don't think that, okay, this is too old or this is too new or anything. Any past, all of them have similar patterns. Okay. The more you practice the previous past papers, the more you're training your brain to, figure out how to solve the new types. So don't get scared that, okay, this is a past paper. Don't know whether the same type of question will come in exam and so on. Don't overthink so much. We have tons of questions similar to each other, so you don't have to worry about this. See the article exchanger, for an example, what the spot rate and futures price and the day of settlement are given. Okay, this is like a spreadsheet tool, where the calculations have been shown at the end. This you can use that, you can figure that out. If I open that, where is it? I just downloaded it actually. They have given the way to answer the question, like you can present all this in the spreadsheet and you can put a working note there and reference that in the exam, that okay, this is the under each of the options, under futures, under money market, under forward market, all of these are the prices under each of them. All of this is what the amount I'll receive, because this question is the question covered in the technical article is about what will be my amount received if I use each of these hedging contracts, respectively, forward, futures, options, and so on. I have to present it properly like this. The more presentable you make in this exam, because of course you have got professional marks out there. So the more presentable you make in the exam, the more you use working note number, the more you reference that and use proper English, use simple English, but without spelling mistakes and all that, the more you're likely to get the full mark, 25 marks. Why will you end up losing it if you're all right? And you're showing your calculations. See, you can see your all the calculations are being shown, and spreadsheet is of course pretty much similar to what is there in the exam. You don't have to worry about that. You can practice in your Excel also. And see, you can see that everything is clearly shown. It's not like I have to figure out where is what. No, I don't have to do all that. So that's how it should be in the exam, and this is what is going to be discussed about in the article. So let's get started. It's going to be exciting because I genuinely feel that these kind of questions are, we solve these questions for the first time because we don't have such advanced level probably in that in the F9 in the financial management paper in the applied knowledge level. But here we have it for the first time in AFM, and that's why it's very hard for us. Like we have never solved such questions before. It's the new thing for us. But once you get used to it, once you understand, once you grasp the concept, once you're flexible enough to grasp the concept, then you're good to go. I don't think it's hard. Okay, nothing is hard if you practice and figure it out. That's something that I have figured out from my knowledge or from experience of writing ACC exams. Noreen is a company based in the USA supplying medical equipment in the USA and Europe. Notarin's Treasury Department hedges foreign exchange risk on transactions using forward contracts, money market, traded futures, or traded options. Now, their Treasury Department is currently dealing with a sale to a Swiss customer of CHF 12.3, which has just been agreed, where the customer will pay for the equipment on 31 May 20x9. Okay. So they are. Please take a note of the date. That is important. And just a minute. Yeah, now I think now I'm good to go because otherwise it doesn't make sense for me without the yeah. So 12.3 is a one which is going to be received from a Swiss customer European, okay, and they usually hedge such transactions. They'll pay for the equipment on 31 May 20x9. Take a note of the date because that's a future date. Today's date is 30 November, so clearly it is 6 months, right? December, Jan, Feb, March, April, May. So 6 months, well and good. So exchange rates quoted as US dollar this to this spot 3 months forward, 6 months forward. Of course, which is going to be applicable? No if and buts to it. 6 months forward for the futures contract if we are taking that. This is the spot rate that is applicable, and we can see this is US dollar to CHF. Okay. So of course, when we get a receipt, what is the risk? We should know about it. When it's a receipt, the risk is that in our US dollars or in our country's currency where we operate, where we majorly operate, in for a receipt, in the case of a receipt, it can reduce. The exchange rate can move adversely and it can reduce, which is why we take up a futures contract and we fix our rate. Okay, that is the whole point of doing it. So I'll figure out. Let's just figure it out together further. Okay, annotate. So as soon as you see the screen, right, annual interest rates available to note. I have just split the screen so that, and this is different day of shoot because that time some glitch took place. But I'm back and I just want to finish this video and make it easier for you to answer the questions and stuff. So annual interest rates, as soon as you look into this screen, you see the investing and borrowing rate. You should not think about anything else but money market hedges. Money market hedges are what this concept is about, and this concept is very simple, right? Money market hedge concept. It's just that you will have to consider whether it's a receipt, foreign receipt, or a foreign payment. So in our case, it's a 12.3 million receipt of CHF, right? The Swiss francs. So we are just going to take 12.3 payment, sorry, receipt, right? And what is a conventional method? By now, I assume you should know about it because I am just going to help you structure the answer. So by now, you should know about it. So 12.3 receipt. Yeah. So as you know, the normal procedure is the 12.3 million receipt. We have got that receipt. Okay. We will borrow that amount. We will borrow that amount in the foreign currency itself, in the CHF itself. Where is the pen? Sorry about that. Yeah. We'll borrow this much amount. Okay, this is the step-by-step process I'm telling you, but not like with figures and all, just explaining you the concept. We will borrow in the foreign currency and then convert it, discount it to today's terms, discount, discount the discount it to today's terms. That is which with which rate? That's where these rates come into the picture. These rates come into the picture, the investing and the borrowing rate. So simply we'll just take the uh, of course, since we are taking borrowing rate and that too in Switzerland, because we are taking the currency in their terms, like the receipt is in their terms and all that. So we'll take the 4.4. However, however, since this is going to be a 6 monthly payment, that means not a 6 monthly payment, I mean it's going to be paid to us in 6 months. So that means this is a future payment happening in 6 months, which means I need to discount it from 6 months to today, which means I need to divide this rate by 2. As simple as that. Because this represents annual interest rates, it's clearly mentioned here. So I'll just divide this rate by 2 and I'll get 2.2 respectively. Uh, just a minute. I think there's something wrong. Yeah. Yeah, this is 2.2. So how we are going to do this 12.3 borrowing, sorry about that. This 12.3 borrowing divided by 1 plus 2.2%. Okay. This is what is going to give me the amount in millions in CHF terms, but discounted in today. Discounted up to today, today's terms. Right? Now, this X amount that we end up getting, we will convert it using the spot rate applicable. Okay, that we'll go into details in the future now. And afterwards, we'll convert that, we'll get in dollars. That dollar amount, that dollar Y amount, we will convert it into, we'll deposit it and have interest accrued on that. Interest accrued, no, sorry, interest earned on that. Because on deposits, we earn interests. So Y and that Y into what is the investing rate of 4.6. Since it is again just going to be deposited for a period of 6 months, we are just going to divide the rate of 4.6, the investing rate of 4.6 in USA, in our home country, by 2. So 2.3, right? 1 plus 2.3%. So this is going to be my final amount that I'm going to have in my bank, and I am certain that this is the amount. So this is like pretty unconventional to the other methods. Here we are having some amount in my bank. I am having this and I'm certain that okay, I'm safe, and whatever my future receipt will come, in the foreign currency, I will use that receipt to pay off my borrowing that I made here. If you remember the initial borrow that I mentioned. That's all. So this is the concept, and hope you understood it. Similarly, for payment, it is a bit different. Payment, I mean, of course, opposites take place. First, to deposit in the foreign currency. I'll write the steps, it's okay. So, if we would have to make a payment in CHF, we would deposit in the foreign currency, that same amount, then discount it in today's terms using which rate? Using the deposit, the investing rate of the foreign country, that is Switzerland here. So, discount using investing rate of foreign currency of foreign country here, and that to 6 months or based on whenever the payment was to be made, right? Then afterwards convert using spot rate so that we can find out the amount in today's terms because we have discounted in today's, and finally borrow the same borrow the same in home country bank, that is in this case USA, home country bank. I'm sorry, it's running a bit slow, probably some glitch again. But yeah, this is what I mean to say. Right? This is just the opposite of what I just discussed previously. But however, take a note of these points. Like you should know, because this is how you can learn in AFM. when you think of one side, for example, receipt is given to us in the question to yourself, okay, how is it like in the payment? How would it be like in the payment? Okay, it would be like that, like that, like that. This exercises your brain into figuring out the AFM topics, into figuring out, revising at the same time. You're revising in a smart way. You're not using the regular textbook method and reading and all that. No, you're revising in the smart way. Okay, this is the question. If it would be like that, how would I answer like that? this is like this was one of my premium techniques when I used to study for this exam, and even when I used to study for my other exams, I used to question myself, in different ways. Okay, what if it would be asked this way? What if that question would have been asked here? So this is one smart way, some smart tricks that I am giving you, meanwhile, to understand, to pass this exam and figure out further about this exam and exercise your brain actually. Now, currency futures contract size, futures price quoted at US dollar per that. So our futures price here given to us is quoted at US dollars this through this. That means this is in US dollar per CHF. This is per CHF like that. And this contract size, the contracts are in CHF terms. So I will just have to take 12.3 million divided by 1 lakh to 125,000 CHF like that. If I want to find number of contracts and all, it's basically for that. And then you get this, you get the rates, US dollar 1.031, yeah, December, March, June. So of course, whenever the transaction date takes place, that is 31st May, after that only some futures date is supposed to be considered. Otherwise, it's of no use. So clearly, I will consider June futures 1.0369. I'm not going to take March and December because they are clearly irrelevant. My transaction is not taking place in any of those months or any of the months prior to them. So I am not going to be concerned with those. Then currency options, contract size. Okay, now this is option contracts, only one thing extra. There's this call, puts, there's premium, of course, because option contracts is where you have the option to even leave if the exchange rate, if your options proves to be adverse for you, right? If your futures or something proves to be adverse for you, you can choose to go and select the market rates and exercise based on that, right? So that is one thing. And afterwards, now what you will do? Okay. Now what you will do? You will choose calls, you will choose puts. What is it? Another confusion that many students have faced, and many students have ended up taking the wrong rates, wrong premiums, and so on. Why to simply lose on a 25-mark question for no reason? Why to not focus on why to not focus on the logic used here? There's a very simple logic. So in our thing, of course, it has been given to us US dollar per CHF, US dollar per CHF. So this I will of course choose June, either June call or June put. So zero. Uh, the exercise price stays stagnant. It is one only. But the thing is, these are all the premium actually. These are all the premiums. And since this is US cents per CHF, that means you will have to divide these by 100. If I take June puts, it will be 0.0086. And if I take June calls, it will be 0.0053 respectively. Of course. So this is about it, right? This is about the premium thing. Okay, that you leave. Sometimes what happens here is they won't give it cents. They will give it directly US dollar per CHF for premium. Please take a note of that. That time you won't divide by 100. That time you'll directly take it as it is. Don't make that mistake anytime. Okay. So simple. Now I have counter, I have base currency. In my this thing, I have counter and I have the no, for your kind information, this is the base currency and this is the counter currency. Okay. And this is what is being given to me, $1.0375 per CHF. Right. Now I am a US company. I am receiving CHF receipt. I CHF is my counter currency. It is all about what is the counter currency. What are you going to do with it? Are you going to buy it or are you going to sell it? It's all the game of that. So you're going to sell the CHF, is it? Right? You're selling the counter currency. Selling the counter currency, and you're selling the counter currency, right? Simple. You'll take puts. If you're selling the underlying currency, your CHF, as you can see here, Your contracts are in CHF terms. You're going to sell those contracts. You're going to sell those contracts because you don't want that. You want the US dollars. So therefore, clearly you'll take put. There's no if and but to that. Very easy. Very easy. Similarly, you're going to sell futures. Simple. Because these are in CHF terms. You don't want CHF. You're going to get a receipt in CHF. You are going to sell them and get US dollars from the bank. Simple. So if futures or options are chosen, any amount not hedged by a futures option will be hedged on a forward contract. Like remaining, for example, sometimes an under hedge or over hedge takes place. Under hedge cases actually, like for example, if 98 is a 98.4 is the contract number, point 0.4 will be hedged in forward contract because of course that will represent some amount. And why should we let that go? We will hedge that in some market, right? And clearly there is no specific like point 0.4 cannot be a size of the contract in futures and option market. Like there's no nothing like that. So at least some minimum number has to be there, which is like more than one or something. So of course, that time you will have to consider taking forward contract option and merge that with the future option, with the futures contract or with the options contract, like that, whatever it is. It's very easy, nothing hard. So we'll figure it out now. Now, mature at the months basis can be assumed to diminish at zero at the contract at the constant based on monthly time intervals. Okay, this is always given as an assumption, basis risk and all that. Futures and options are mature at the months, and that means whatever June futures are there, whatever put options of June are there, they mature at the month end. That means at June end. Simple. So, you must read the requirements before reading the scenario, knowing you have to do with help you analyze and ensure that you are answered the question fully. Of course, evaluate which of the possible methods of hedging being considered would give the highest receipt. The highest receipt, assuming the options are exercised. So, assuming the options are exercised, that means sometimes in options contract we assume we might have an option to let it go, right? Here we are considering the options are going to be exercised as well. So which means there is no like even if options have an option to not be exercised, here we are assuming we are going to exercise it and we are going to find out the receipt under options contract. Just in case if some student will be smart enough, will be over smart and be like, okay, what if I don't exercise the option contract itself because it's an options contract. So for that purpose, this assumption has been given to us in the question itself. So which is why it is said, please read the question properly, right? Don't do such over smartness. Now identify the important data. Now they have given you the correct way of answering. What is the important data to be considered in our scenario? Hedging methods, transaction to be hedged, time period, smart and say. Hedging methods, whatever hedging methods we know from the textbook and all that. Transactions, what is a transaction? The receipt and the payment, the amount, the time when we are going to pay, the transaction date, how many months are there, and you should be aware of today's spot rate, the forward rate at 6 months, after 6 months, and so on, like that. Now, of course, and these are the four contracts to be measured. And Nortrin is a company based in USA, currently leading the sale of Swiss customer of CHF, yeah, which has just been agreed. This we already know, right? Um, to a Swiss customer, not of a Swiss customer. Sorry, I'm just reading it so fast. I'm ending up doing it like that. But I just want to make sure this video doesn't go so long and you guys will end up getting bored. I am not that type of person who bores people. I just definitely want to make it interesting. So, trying my level best on that. So, needs to hedge against the USD strengthening, the CHF weakening. काट लेना. One more thing I forgot to mention about is the basis thing that I read here. It is assumed that it is going to diminish at a constant maturity, at contract maturity at a constant rate based on monthly time intervals. So this will be helpful in finding out the futures lock-in rate, the rate to be considered. So what is basis risk? Okay, it's nothing. It's very simple. It's just that my futures rate, okay, my futures price today, right? It is going to differ, or not today. Let us just consider my futures price on the future date is going to differ from the spot rate for sure, right? Spot rate on the transaction date, right? So what I will do for that, I want my futures contract to completely hedge my transaction. It should completely at least ensure that 12.3, I just have to pay certain amount of dollars only, or I should get as much gains as possible for my futures contract. Okay, but this basis risk, this problem with the fact that my market rate and my futures rate won't go hand in hand together. I mean, it is almost going hand in hand, but not completely. That some small points difference in all will cause me to lose on my gains. That is all my concept of this is basis risk is. Now, what they are saying is, what this line means, this thing at a constant rate based on monthly time intervals means we are going to apportion it based on how many months are over, right? We are going to consider this basis risk based on how many months are there till the transaction takes place, till June end. For example, if I have taken my November, I have taken what we say, the spot rate today, and I'm going to subtract it from my futures price on that day. Actually, it's better I give you an example and explain like from the scenario, because like this you won't understand. But what it is, it's just the difference between the futures price and the spot rate, and into the number of months till the futures expires, right? That should be the denominator, and the numerator will be the months till the transaction date. So months till my futures contract expires, and the above thing will be months till my transaction takes place. I'm writing in short because no much time, it will take time. So this is how we are going to apportion the basis difference, the basis, right? And we are going to include that in the futures price lock-in rate. By now, I expect you to know the lock-in rate as well. This is the rate which we are going to, we have this, we are not blatantly going to consider the futures price. We'll also consider other things, right? The options price also. We are not directly going to consider the futures price under the option, and that's it. We'll have to consider the basis risk, we'll have to consider the associated premium to it, and all of this sums up to lock-in rate, which will be used for converting my CHF to USD. So now you're not understanding for sure. You will be like, this is gibberish, whatever she's saying. But let's dive further into the question for that purpose, right? So forward money market trader, these are all the hedging methods to be used, and this is what you should use here, because there's no specific hedging method suggested in the question. So we can use all of them and see what is the case like. And not only is a company based in USA currently dealing with a sale, yeah, again and again same. The risk here, first of all, you should mention the risk here is the USD strengthening and the CHF weakening. CHF weakening means you will get more in CHF terms, but as soon as you convert into USD, your home currency, your amount will fall. So you don't want that to happen. You want that to at least be equal to what is in today's terms, or more than that. You want to get gains anyhow in USD. That's the main purpose. Now, so they are telling us what we'll do: buy, sell. What I already explained you. So here it is nothing. It is first in forward contract case, we'll sell CHF to bank at forward rate. Yes. So one more thing that I forgot to mention about is how we will consider the bank and this connection, bank and forward rate connection. First of all, it is running so slow, my laptop. Seriously. Now it will go in the next page. So first of all, I forgot to mention about this, the bank thing. Uh, Bank. They offer us with ask and bid rate, right? Always we should know bid is smaller than ask. Another thing that we should know is bid is used for buying the counter currency, and ask is used for selling the counter currency. This is always what has been observed. What is the thing? Selling counter on the bank's part, okay? Now we always have to think that bank is going to be profitable here, because bank's business is about the bid and ask spread. They will subtract what they are selling from the ask, because that rate is higher, and they'll subtract the bid from that, ask minus bid, to get the profit, to get the spread. And that's the way they earn from the business, from the foreign exchange translation business and all that, right? So from the trade and all here. So for example, in our case, they have said here, what is the counter for us in the forward contract? If you consider, if you go here, if you consider here, what is a forward contract? It is in US dollar to CHF. CHF is a counter currency. They are going to sell. We want to sell the counter currency, right, to the bank. Okay, maybe you will get confused like that. See, this is all, whatever just said is for the bank. Okay. But now I will have to see my forward contract rates, that is in US dollar to CHF, and I will have to see what I'm going to do with the CHF, with the counter currency. I am going to sell it to the bank. Selling to the bank means the bank will buy at the bid rate. That is a smaller one. Consider that is smaller for sure. So therefore, the rate that I will consider in my forward contract, the 6-month forward contract, will be 1.0356, the bid rate, because bank will always purchase from us in from the smaller rate. That's it. No other if and buts to it. I have clearly explained what I have to say. That's all. So sell CHF to bank when money received from customer, that is in 6 months time. So 6-month forward rate. Borrow in CHF, as I already mentioned here, borrow in CHF, the amount borrowed will be repaid by the CHF receipt from Swiss customer, correct? So you will borrow, then you will convert, borrow, discount it using the borrowing rate of the Swiss bank, or what we say, of the Swiss banks here usually, and then convert that amount, discounted amount, to USD, invest that into USD, US bank, at a deposit rate, and accrue or include a deposit rate as well, in the, add that deposit rate as well in the uh, amount invested. And then whatever you might have borrowed in CHF terms, you're going to repay that using the CHF receipt that you'll pay, that you'll get. Right. Then futures contract, sell CHF futures now to hedge against sale of CHF when money received from Swiss. Yeah, sell CHF futures now, um, to hedge against the sale of CHF. We want to sell the CHF basically, and buy CHF put. Put options means selling the underlying underlying contracts, that is selling the underlying CHF. That's it. To hedge against the sale of CHF when money received from Swiss customer. That's it. So two things to be done: the length of time between today's date and date of settlement. 6 months, the date of settlement, 31 May. We have to consider this, and we have to, because of, finding out which futures, which forward contract will be useful. So this is, see, technical article is literally walking you through every step by step, how you're supposed to, what you're supposed to consider. Just like a baby, they're spoon feeding you what you're supposed to consider, what is a month, how many number of months are there, these are the due dates, and so on. So it is very easy for you. Like, there should be no way that you're failing this exam. So please read through these articles, understand where you're going wrong, how is it going like, and so on. Please. Now, 6 months forward rate will need to be used. Annual interest rates will have to be divided by 2, correct? Whether it is investing, whether it is borrowing. Date of futures will have to be after May, definitely. And date of options will also have to be after May. Because option actually considers futures inside it. Okay, even if the exercise price or premium, the way it works is different, technically it has a futures concept inside it. In our question, okay, I'm not going to confuse you further. In our question, it is not like that, but like everything is given to us. In every question, it will be given to us. But technically, I've seen questions where futures and all, uh, futures price, futures exercise price is being given to us. Like, it's just that options is attached to the futures contract through a premium, where futures exercise price is stay same, like, how it works in the futures market, but there's an option thing, there's an option premium to be paid, so that you have an option to either exercise it or not exercise it. So that is one thing. I'm not confusing you. Okay, I'm not going to speak about this any further. zipping my mouth on that. So spot rate. Remember, the bank always wins. So if there's a choice of two exchange rates, choose the one that gives the lowest receipt. Of course, the lowest receipt for us and the higher receipt for them. Or basically, they will have to pay less in purchase terms, in purchasing price terms. So that is only possible using bid rate, right? What I just explained to you, it's just saying that in different terms. That's it. So implications for hedging methods. Mm, yeah, so it is saying here use lower of two rates, that is 1.0356. In money market, it is not relevant. I don't understand why it has said this thing here. Implication for hedging. USD receive and translating CHF amount borrowed. I mean, this is just explaining you the thing. Use lower of two rates as multiplying CHF to obtain. Use. Yeah, so basically, mm in case if you there is a step where you will have to convert. So first of all, it is saying not relevant here. I don't understand why it is saying not relevant because um, it will use 1.0356 for sure to convert CHF to that. Like bid rate is the lower one for bank. And yeah, just don't listen to this article. Listen to me. I'm clarifying it for you. So money market is determining USD receiving when translating CHF amount borrowed. So it is just telling you step by step where all we will use this concept of bank winning always. Right? So in forward contract, either it's saying not relevant, but I would say it is relevant because we are going to use one of the bid and ask rate. So we are going to use 1.0356, the bid rate, because bank will win in this situation. In money market case, it will be use lower of two rates when you're converting. So which rate is it specifically talking about? Let's come back to this area. This is the spot rate given to us, right? 1.0292 and 1.0309. As I said already, the bank, when you're going to when you're going to borrow something, right, you're going to borrow in foreign currency, you're going to discount it then, and then you're going to convert it using the spot rate. If you remember this step, this spot rate is what it is talking about. So 1.0292 and 1.0309, we have to make a choice. So what will you do? As it said, where the receipt is going to be lower or where the bank will have to spend lesser to give us the US dollars, and that is in 1.0292. That is as simple as that. It is 1.0292 USD per CHF, right? So it is going to be simply you will take 1.0292 USD per CHF. That's it. So why 1.0292 and not 1.0309? Because we'll get higher receipt there. That is the ask rate. That is the rate at which the bank sells to us, not buys from us. So that is also one thing. So we will therefore consider 1.0292 the rate at which the bank buys from us, the CHF, the counter currency, which is this CHF. That's all. Nothing more complicated. Nothing is there to, get so cranky about it. We'll consider this 1.0356 similarly. And in futures price also, we have only one thing given to us. Here also only one thing given for puts. However, we'll take June premiums 0.86 for puts. And that's all. I've gone through my figures. I've gone through everything. And now I will, this, that gives lowest receipt. Yeah. Here it is given to us, lower of two rates, 1.0292 as multiplying CHF receipt to obtain it. Okay, could be used in the basis, could be used in basis calculation. Use lower of two rates as multiplying CHF receipt to obtain it, and the use of lower rate will mean fewer USD receipt. Yeah, that won't be translated. So because it's already given to us in that, you are just going to basically why it is saying this is because you're just going to convert You are going to find out how many number of I'll just tell you step by step. Like this, you won't understand anything. Use lower of two rates as multiply CHH to obtain USD, and use of lower rate will mean no, you'll not understand anything like that. So now you'll use 1.0356. Let's come to forward contract. You'll use yeah, you will use 1.0356. You will multiply that with the 12.3 million receipt and you will get this amount. Okay, this is the fixed amount that you're going to pay. That you're going to receive. This is USD dollar. In 6 months' time, you'll get this. Okay, and use of lower will mean few. I mean, see, this you will get according to the forward contract, but according to market, it can differ. So the problem with forward contract is you are fixing yourself into it, right? But you don't know how exactly the market will move. It can even go adversely, it can go favorably. So you're taking a catch here, you're just taking a risk here, but that's all about you choosing forward contracts. That's why options are more preferable here because you have an option to not exercise in case if options contract don't prove to be useful here, right? Now you use 6 months rate and lower of two rates as multiply CHF receipt to obtain USD and use of lower rate will mean fewer USD. Yeah, that's all it's saying. So 6 months one will be 1.0356 and you will use that. Now in case of money market hedge, as I already explained, you will borrow the amount and you will discount it by 1 plus 0.044, that is 4.4% by 2, right? How we discounted 1 plus this rate, power n. Here we are not doing power n and all, we are just going to do 1 plus the rate being divided by 2 because these are annual rates. We are just going to divide it by 2 to make it 6 monthly and that therefore will make the 6 month amount converted to today's terms, which is 12.03 by 225. So according to money market hedge, it's like that. So I'll just take a note of all this because then it will be easier for me to refer to this forward contract. Okay, how much is it according to that? 12.737880 million. Okay. Then dollars. Here, money market hedge. I'll write in short form. Money market hedge. It is no. In money market hedge case, it is not going to be the final amount because we are yet to convert it into USD. Right? Take a note of that. So this is just explaining what rate when why we are taking this. As I already explained you this above. If you are in the previous in first 20 minutes itself, I think. Now convert into US dollar at spot rate. This is the next step in the money market hedge process. The 12.035 that you borrowed along with discounted is going to be now multiplied with the spot rate. Which spot rate? Already I explained you 1.0292, the bid rate for the bank, the rate at which bank will buy from us. So into 1.0292 and you will get it 12.386. Now what you will do is you will invest it in the bank in the US bank. So 1 plus 0.046 by 2 because it is just going to be invested for a period of 6 months, clearly mentioned here. And you will get 12.671547 being the final amount. So I'll take a note of this 12.671547 million because I've converted this into decimal like that. Right. So then futures. Although I don't have to write so much, but what if my futures and options and all will have similar decimal points? So then it will be easier for me to compare. That's why I'm writing all decimals and all that. But in exam, you don't have to write so many decimals. And in exam, I would rather say don't convert it into millions. Just write it as it is, like 12 with the commas and all that. So forward money market hedge, okay, clearly I can see forward is proving more beneficial. You're getting higher receipt there, but let's see. And then futures, you are going to sell the CHF futures because our contract size is in CHF terms. Right. And you're going to use June 1 because, of course, that is after the transaction date, 31st May. Number of contracts to be used is 12.3 million divided by 1,25,000 being the contract size, 98.4, and we'll only consider 98. We can't round it off to 99 because that will be overhedge and that is not really feasible. Like zero point 0.4 is usually underhedged. If it would be maybe 99, 98.8 or something, then we would have considered overhedging. But here it is 98.4, 98 is better. So hedging 98 into 1,25,000. So that means we are only going to consider 98 into 1,25,000 being the contract size for each of the contracts. Uh, that is 12.25 million. So only 12.25 million will be hedged using the futures market. That's it. The remaining zero point 0.4 will be hedged using the forwards market. Very simple. Zero point 0.4 into, I would say, no, not like that. We are going to, actually, we can even multiply zero point 0.4 into 1,25,000, right? Let's see how much that gives us. 0.4 into 1,25,000, 50,000. That also is correct. Or the other way around could also be you subtracting the entire 12.3 receipt minus the one that you're going to hedge using the futures contract, and you end up getting this. Very simple. Fine. So, receipt would be, since this is going to be hedged, this remaining small hedge that is yet to take place, that has not been hedged using the futures market, we are going to hedge that using forwards market. Same thing is going to happen in options contract also. So this into 1.0356. Why 1.0356? I'll walk you through it again. We have already considered 1.0356 for the our forward thing also, and we got this amount. Now we are also going to consider the same thing here for the one which is not hedged under futures market and options market also. 1.0356. This is the ask rate, sorry, the bid rate, the rate at which bank will buy the CHF from us. So we are done with this. Yeah, we are done with this, and now we'll go to we got the number of contracts, okay, 98, and now we are going to consider, yes. So the basis risk concept that I was talking about comes now, and usually people end up making mistake in this, but let's just simplify it very much for you. And so my March futures, they have done it using two methods. Let's just consider it here. I'm going to switch to this page. I'm going to add one page here, blank page. Why it is adding in the other thing, yeah. So I want to consider, I have two methods. One thing I'll consider 1.0336. Where is it? Yeah. 1.0336, which is my March futures price. Okay. And I will consider my on top of this, I will add the basis risk that is going to take place. Basis risk is basically a cost for me. Okay. Or I can just say I will consider this as part of my, you know, I'll consider this as part of my this lock-in rate for my futures contract. Lock-in rate, that means the rate at which I'll finally convert my receipt to USD, the rate, final rate on the futures price. So here I can see that 1.0369, right? 1.0369, here the rate 1.036, 1 minute. Why am I looking at the wrong thing? Oh God. 1.0369 June futures and March futures. Okay, there is some difference, right? What we can do is, using this difference, we can, like, add up this amount. Where is this? 1.0369 minus 1.0336. We can add this amount, add this difference up, and then we are going to multiply this based on how many months are over. So from March, as I gave you the formula before, from March to June, how many months are there? Considering March end, because these are all futures at the end of the month. So March end means April, May till June end, right? So I can take it till 3. Okay. And how many months from March end till my transaction date to take place? That is April, May end. So 2 by 3. Okay. Simple. I'll add this amount, and that's what they have been doing there. This is how I'll find out my futures price as on 31st May 2000, whatever it is. 31st May, right? This is one way of finding, and that is ending up giving me 1.0358. Actually, I'll just recheck in my calculator if that's the case, because that sounds more authentic, right? Me doing it. 69 minus 1.0336 into 2 divided by 3 and plus 1.0336. Yeah, so 1.0358 is what is the correct futures price here in our case. Okay. So what we are doing here is that I am accounting for June futures price and I'm accounting for the March futures price. I don't know what is my futures price as on 31st May. I need to find that out, right? I need to find out as on 31st May how I'll get. So this is basically the adjustment I'm making. You might have understood it. Like starting from March end, I explained you properly now. Starting from March end to June, how into 2 by 3 and all, how it happens. And then we end up getting the lock-in rate, and using this rate, we'll exercise. So at least it makes sure that we are accounting for the future spot rate and the current futures price at which we are going to exercise. For example, if you would have taken the March futures, and we are finding out the difference between that, because the difference between the spot price on the maturity date and the futures price is always the basis risk. So technically we are accounting for the basis risk only, which is why this sentence is applicable for us. This thing, basis can be assumed to diminish to zero at contract maturity at a constant rate on a monthly time interval, which is why we are considering 2 by 3 monthly time interval. Simple. Or don't get into all these complications. Simple thing is, this difference is the basis risk. They are saying monthly time interval is allowed. So this is March. I'll mention this March. This is March. This is June. Oh God, where is it? This is June. Okay. So I'm accounting for the difference between these two and time apportion basis, because I'm finding out how many months it is from March for the transaction to take place, which is exactly 2 months, 31st May. That's it. So we get the lock-in rate based on that. The other way of getting the lock-in rate is by considering December futures. Or let us see how they have considered, so that you read the article further and understand it better. I'm just going to decompose the article for you. So we can see that, okay, for example, if they have considered one, they can even consider November spot rate. The spot rate is basically the rate at which I have entered. That is on 30 November. That is today's date. They are saying 30 November. So that date also you can adjust based on that as well. So the spot rate 1.0292, that I already told you about, the bid rate, plus 1.0369, the June futures, 1.0369 minus 1.0292, 0292. And how we will time apportion this thing? Okay, this is plus, by the way, not multiplication. Okay, this is multiplication. Okay, wait, this is multiplication. So how it is? November end, December, Jan, Feb, March, April, June. Are we going to take 6 months? No. 1 minute. Is it 1st November or 30 November? Yes. So 1 minute. December, Jan, Feb, March, April, May, and June. There are 7 months. I'm sorry, I got confused right now. There are 7 months to June from 30 November onwards. And to 31st May, from 30 November to 31st May, it is 6 months. Okay. So we can do it this way as well. And we'll end up getting, I will calculate it and do it because I'm very interested in the calculation. So 1.0369 minus 1.0292 into 6 by 7 and plus 1.0292 0292 1.0358. So we are getting the same rate technically, is it? Yeah. Same rate under both. See, under both the methods, I got the same rate. So 1.0358. 1.0358. Okay, this is my lock-in rate for the futures price. I can use this as well. So we got it, and so use 6 by 7, and this is also another shortcut method that we are accounting for. And now if you use 1.0358 and 12 point, how much we are going to hedge, that you have to recall. So it is the amount that we are going to hedge. Mm, yeah, same. This 12.25 is what we are going to hedge into 1.0358. Same thing only. So that 12,688 plus the remainder that we hedged using the forward market that I already mentioned here, 51.7 already mentioned here, 1.0356, the remaining that point 0.4 that I talked about. We'll add that as well because we have to consider the entire 12.3 million amount, and we end up getting 12.74 under futures option. So it is how much under futures option? Actually, you know what is best? You should consider that in a tabular format, like this is how much I'm getting in futures, money market, forward. You should keep on mentioning that so that you can make a better comparison. That's what I had also learned from my coaching classes and all that. You should make a tabular thing so that it's very clear as to what has been done, and then afterwards you can make a clear conclusion about or make a clear comment, however it is like. So buy CHF options to hedge against sale of CHF and money received from Swiss customer. Buy June options that we already discussed already. June put options are going to be bought. And afterwards, we are going to consider again same contract size is there under options as well. 1,25,000, 12.3 by 125, 98.4, 98 hedged using options contract. That is like what is the size that is going to be 98 into 1,25,000, 12.25, and the remaining what we say. Uh, Yeah. So that thing is 12.25. It is just saying 12.25 into 1.0375. They have considered the exercise price here. Okay. Is it so? Is that the exercise price? Let me recheck. Yeah, 1.0375. So they consider that under that. And basically again the same thing, forward contract will be used for the remaining point 0.4 hedge. So yeah, 12 1,25,000 into 98 into 1.035, this much is options contract part, and the remaining is what we say 50,000 CHF. Or if you want to find out, you can also subtract 12.3 minus 12.25, that is the remaining 50,000 is the CHF that we are going to multiply with the forward rate 1.0356, already discussed thrice in this video. And 51,780 is what that we get. And then afterwards it's yeah, that's it. And afterwards you also consider there's no lock-in rate or something, all of this thing here. There's this premium instant. So premium that we'll consider for June puts is 0.86. As I said, it is given in cents, so we'll have to like divide by 100. 0.86 by 100, which is uh, if we say 0.086 or 0.086 actually. um Totally confused right now. 0.0086 is the correct thing. And that we are simply going to multiply with how much amount is hedged under options contract. So what you can also do is you can take uh you should take this 98 into 1,25,000, that is 12,25,000. You can directly multiply 12.25 into the 0.0086 here, or you can take 98 into 1,20,000. It's basically the same thing. Okay, they are just trying to decompose it for you, simplify it for you so that you can understand, okay, how this came. Okay, 98 is a contract number of contracts, 1,25,000 is a contract size, and so on. Yeah, and then this is how it has come. And then you find out uh, since 0.0086 is already in US dollars, we don't have to worry about it. We don't have to convert it and all that. And we are directly going to multiply 98 into 1,25,000. But wait a minute, if that's in CHF, yeah, yeah, correct, correct, correct. So you will get in CHF and then you will multiply that into 0.0086. So it's like for each contract, CHF contract, this much US dollars are the premium. So you don't have to convert that. Okay, it's not like you will convert the 1,25,000 contract size into US dollar first, and then you will multiply that this what we say premium, because it's already quoted in US cents, not US dollars, but it's quoted in US cents. It is quoted in US basically currency already. So all you have to do is just multiply it with the contract size. It will automatically convert that contract's the premium out of that contract into US dollar premium. That's it. You don't have to worry about it. So that's all about it. Then you subtract this amount from your receipt under forward and options contract respectively, and then you find out 12.655 is the amount. So under options, it is 12.655. Under this futures, it is what we say, the total summed up here. It is 12.74. And under forward, it is 73. We can see for futures is giving us the highest here, and futures is giving the highest. The options gives a lower risk because of the premium, and yes, the premium. So if the premium wouldn't be there, how much would it be? So considering that 12709, because some answers even consist like that. What if the premium was not there? Because we want to signify how much loss the premium is creating. So we'll say that it is 12.76 without the premium. So clearly options would have been the highest, preferable, if the premium wouldn't have been there. So we can say that we can mention that point as well, because of the premium this is happening. Otherwise, they give would have given a higher receipt. Futures will be subject to the risk that basis the difference between the futures and the spot price may not decrease linearly as the futures approach maturity, as assumed in the above calculations, and the receipt may be unpredictable despite the future hedge being taken out. So the thing is, they are saying that this basis risk, we are assuming this thing right here. We have assumed that we have calculated, we have assumed that into 2 by 3, this is linearly, this is every month interval, it is going to, it is based on monthly intervals. But in reality, what if it is not monthly intervals? What if it is not going to be what if the difference will remain the same? What if the actual spot price and the futures price has a very large difference and it will prove to be an ineffective hedge? We never know. So we need to mention about these assumptions in our comments. We need to ensure that we write this imperfect step out, that even if it is a higher receipt, there are these risks involved. And despite we have taken a futures price, futures hedge, it might be, unpredictable. It is imperfect. It could be imperfect because of this basis risk, right? Because the actual thing on the date of the transaction, 31st May, and this futures price that we have guessed will be different. There will still be basis risk. It will not diminish to zero. We have assumed it will diminish to zero, may not decrease linearly as the futures approach maturity. It will not, what if it is not decreasing itself? What if it is increasing itself? We don't know about the real market conditions. So all these are the risks associated to it. And so this is how they have, helped you answer this question. And similarly, they have also given you this thing. They give this example here. Thank you so much, guys, for uh, staying till here and figuring out stuff along with me. And I genuinely believe this topic is going to be easier. And if there are any doubts, you can even contact me on LinkedIn, on Insta, on uh, or even on YouTube comments and so on. And I'm always available for all of my students. And yeah, so signing off. Have a good day ahead. Okay, bye.